Let's quickly talk about accounting for S corporation. I want to explain to you everything that you need to know if you have an S corporation and you're trying to really take care of accounting for that corporation. So here's the overview I want you to pay attention to. The thing is, first of all, when you have an S corporation, you got to have a robust accounting process in place because the IRS is pretty demanding. They're going to start looking into your processes, your tax filing, and other stuff. And you really want to make sure that you comply with all regulatory all regulations. Right? And the thing is that when you think about an S corporation, think of it as a flow-through entity. In other words, the way we analyze S corporations versus C corporations, for that matter, is that C corporations are basically subject to double taxation, whereas S corporations are subject to simple taxation. So this is why you got to look at an S corporation as a flow-through entity. In other words, the corporation itself does not pay taxes, but you, as the owner or as the shareholder, you're paying taxes at the personal level. In other words, on your Schedule C, when you file your Form 1040. So this distinction is really important. Okay, and so the accounting system for S corporations is generally the same as for a C corporation. However, since there are differences in tax treatment, the accounting can be a little bit different. Specifically, an S corporation should have 4 main equity accounts, including common stock, which is really issued at a nominal value. You have additional paid-in capital, you have distributions paid to the shareholders, and you have retained earnings. So basically, all those 4 accounts that I'm just talking to you about, they are located in a financial statement called shareholders' equity. Okay, basically, when you have an S corporation or a C corporation or on an LLC for that matter, you have 4 primary financial statements. You have a balance sheet, you have an income statement, also called P&L, so that's the profit and loss statement. You have a statement of cash flows, and the 4th statement is actually the shareholders' equity statements. So this is where you have all those 4 accounts I just spoke to you about. Let me just say them once again so you were clear. You have common stock, you have additional paid-in capital, you have distributions paid to the shareholders, and you have retained earnings. So when we talk about common stock and additional paid-in capital accounts, those are accounts that really can fluctuate, okay? And it really depends on how the S corporation is set up. I'll talk about that later on. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. So when we talk about common stock and additional paid-in capital accounts, so common stock along with the additional paid-in capital represent the total amount of capital that was invested into the business by each shareholder. So while both accounts represent the same item, they are unique from one another due to the fact that each shareholder should have his or her own accounts for stock and another for the additional paid-in capital. And notably, while the C corporation will have 2 separate stock accounts, one for common stock and another for preferred stock, the S corporation can only have 1 class of stock. Therefore, 1 common stock account will actually suffice. Okay, and the thing here is that when we talk about distributions paid to the shareholders account, technically speaking, an S corporation doesn't pay dividends since the profits and losses of the corporation are passed on to the owners. Therefore, instead of referring to this account as distributions, S corporations refer to it as distributions of earnings and profits. And what about the retained earnings account? Remember, I was telling you there are 4 accounts that you'll find in the shareholders' equity statement, right? Common stock, additional paid-in capital, distributions paid to the shareholders account, and the 4th element, which is actually the retained earnings account. Now, unlike the C corporation's retained earnings account, the S corporation account here is pre-tax money that has been allocated to the owners but not distributed. C corporations, however, have this account to reflect the after-tax money that the corporation holds on to instead of paying it out in dividends to the shareholders. And so due to these differences, that if the S corporation wishes to revert back to, let's say, into a C corporation, the same retained earning account, the same retained equity account cannot continue being used. Additional calculations will need to be made in order to reconcile the accounts to reflect the proper balance. And so based on the complexity of such tax issues regarding S corporations, it's important for these businesses to maintain accurate records in terms of the business's operations, including expenses, income, capital investments, and the like, okay? And so moreover, the corporation must keep records of all shareholder investments. This can include cash or property investments. And since all money is actually passed through to the owners and shareholders to the extent of what they have invested in terms of, let's say, capital, the accounting method must be up to date to prevent any issues down the line, especially when it comes to tax issues. Like you don't want the IRS to start really looking into the books and really start asking questions. Whilst I want to quickly remind you of today's topic, we are having a conversation about accounting for S corporation. Let me dig a little deeper when we talk about the tax basis for S corporation. The thing here is that the tax basis for S corporations represent the total of the stock basis and loan basis, also referred to as the debt basis. Let me give you an example. Let's say you invest $20,000 or $25,000 in $25,000 in the corporation, receiving stock, and also loan the company $5,000. So your tax basis is 25 grand, right? We have 20 grand, which is an equity investment. And in this hypothetical example of $5,000 loan to the company, you have 20,000 plus 5,000, that's 25,000. So the tax basis is often increased by certain pass-through items. In other words, net income, and then decreased by other pass-through items. For example, losses and deductions. So when calculating your tax basis, you must calculate your overall tax basis by using the stock basis first. So the number must be 0 or greater, and then calculating in actually your loan basis, which must also be 0 or greater. So if I give you the earlier example of 25 grand, let's assume that for the $20,000 you invested, you received 100 shares of stock. Now assume that you have John Doe also invested 20 grand, receiving 100 shares of stock. While your tax basis is 25 grand, the investment plus the loan you actually granted to the corporation. John Doe's tax basis is 20,000. At year end, the corporation has $50,000 of net income. You and John Doe are each given 25 grand since you both have 100 shares of stock, right? Now, therefore, both of you must report this money as net income. Now, both you and John have increased your stock basis to 45,000. So this is 20,000 plus the 25,000 distribution, $25,000 distribution. And so your tax basis is now what? 50 grand. Think about it. So this is $45,000 stock basis plus the 5,000 loan basis that you have. John Doe's tax basis is 45 grand, which is also equal to his stock basis since he did not lend any money to the corporation. So your tax basis is $50,000, but John Doe's is 45 grand. It's really important to really understand that those calculations are important because they will actually serve as your basis when filing things like taxes and others and other documentation. Now, an S corporation reports total income and expenses at the company level and passes through a share of net profit or loss to its individual shareholders. So it's really important to understand that. Now, an S corporation must maintain, therefore, a records of each shareholder's investment of cash or property. These records are crucial for establishing its shareholders' percentage of ownership in the company. Let me really get into the details here. I really want to explain to you. Let's talk about accounting for income and expenses. Now, S corporation accounting is generally the same as C corporation in terms of income and expenses because those are reported at the corporate level, right? We're talking here about basically having the P&L, the profit and loss statement, also called income statement. So S corporations can choose an accounting method that's best suited to reporting the income and expenses of a particular company. They're not required to use the accrual method of accounting. So remember, you have the cash method, you have the accrual method, and you can also have a hybrid method of accounting. One thing I need to say here is that basically when it comes to US GAAP, so this is a US generally accepted accounting principles. So accounting principles, they're accepted in this country. You want to go with the accrual method, okay? Especially when it comes to actually file paperwork to actually file for loans and all that kind of stuff. You want to have US GAAP. And so basically income and expenses retain their character when they're passed through to shareholders. For example, long-term capital gains are passed through as long-term capital gains. And it's important now when we talk about accounting for, so this is for accounting for income and expenses. What about accounting for shareholder capital? I think I spoke about this earlier by saying that everything happens in S corporation capital accounts, right? So everything happens in S corporation capital accounts, and those are within a statement called shareholders equity. I also spoke about that later on. So income and expenses go to the P&L, so the profit and loss, and shareholder capital go to the shareholders equity financial statements. And so in there you have all kinds of cash inflows and cash outflows. So you have when you invest cash and property, you have a plus in the shareholders equity account. When you have equity, you have that, and there is something called adjusted basis that also increases or decreases the basis that the shareholder has when it comes to his or her equity account. But everything depends on the situation here. Boss, I want to quickly remind you of today's topic. We are having a conversation about accounting for S corporation, and I'm trying to really break it down for you to really simplify a somewhat complicated topic, if you will. Let me talk to you about the loan basis. So basically, when we talk about the accounting for shareholder capital, you have loan basis, and a shareholder can advance money to an S corporation as a loan. That's what I gave you an example earlier when I said you loan the $5,000 to your S corporation. Okay, so a common example is a shareholder that pays for company expenses using his personal credit card and submits an expense report to the company for repayment. And loans can be short-term to be repaid in 1 year or less, or they can be long-term, basically to be repaid in more than a year. It really depends upon what really works for your business. Note, shareholders who make loans to their S corporations can take a tax deduction in their current year for losses in excess of their stock basis, but only to the extent that they have loan basis. So you want to begin with the initial amount loaned to the company to calculate loan basis and adjusted loan basis. You want to add in all additional amounts loaned to the company and deferred interest that is capitalized or added to the loan instead of being repaid. Okay, and again, everything I'm saying to you here, in the interest of time, I'll be really going a little faster. But if you have specific questions, please, you can put them in the comment section, or you can just reach out to us via email, and our team members will actually study your question and get back to you. Okay, and so basically, talking about the loan basis, you basically want to deduct the amount of loan principal that has been repaid, any amounts of loan principal forgiven by the shareholder, and the amount of the loan principal converted to stock. You must also deduct the share of net loss in excess of a shareholder's adjusted stock basis, and the result here is the adjusted basis in S corporation debt at the end of the year. Okay, and this is an important element. You also have to account for negative basis and suspended losses. So adjusted basis cannot be below zero, but using this formula for calculating adjusted basis often results in a negative number. So handling negative basis of S corporation stock involves reducing the shareholder's stock basis, but not below zero, and reducing the shareholder's loan basis, but not below zero. So anything can never be below zero. Any excess negative basis is treated as a non-deductible loss. So this excess loss is a suspended loss and can carry over to future years indefinitely. And the suspended loss can be deducted in any future tax year during which the shareholder has restored her loan basis or stock basis. And so the shareholder must restore her loan basis before restoring her stock basis in the following year if she had both an equity investment and also advanced a loan to the company. Okay, but again, I want to say here is that everything depends on the specific situation that your S corporation is in. Let's talk about restoring basis. Shareholders can restore their stock basis or loan basis in several ways. The easiest way is to make additional cash investments to restore stock basis, or to advance additional cash loans to restore loan basis. An adjusted stock basis and adjusted loan basis should be calculated provisionally just before the end of the year. This gives shareholders sufficient time to make additional loans or equity investments to ensure that any losses are fully tax deductible. Let's talk about at-risk rules, okay? And each shareholder in an S corporation has an amount at risk. Very important, that makes sense. and that's the amount of money he or she stands to lose from his or her investments or loans to the company. A shareholder's amount at risk is calculated as the adjusted stock basis plus the adjusted loan basis. And what happens here is that any loss in excess of the amount at risk is called a suspended loss. That's what I spoke to you about earlier. Okay, it's very important for an S corporation and its shareholders to track adjusted stock basis and adjusted loan basis accurately, because each shareholder's stock basis and loan basis will be adjusted to his or her pro rata share of losses, even if those losses are suspended because of the at-risk rules. And this has some implications when filing personal tax returns, because the whatever pro rata share of losses, you're going to have to actually transfer those to the Schedule K1 of that specific shareholder, and that shareholder will have to file when that shareholder actually files his or her 1040, Form 1040 and Schedule C, we have to include that information. What about passive activity losses? And this is an important element to really pay attention to, and this is distinct from at-risk rules, okay? S corporation shareholders are also subject to the passive activity rules, and those are rules that govern to what extent an S corporation loss is currently deductible by a shareholder, and S corporation losses are deductible only to the extent that the shareholder has passive activity income, and so if the shareholder does not actively participate in the business. In other words, you need to have basically a shareholder who's a little quote-unquote detached from the business, so that you can actually file or you can actually account for those passive activity losses. And one thing I want to say here is that passive activity income includes passive income from S corporation, partnerships, trust, interest, dividends, and other investment income. The whole idea here is that you're not really working on that particular activity on a full-time basis, but that activity is generating income for you. Okay, and so if you can have income, you can have losses, really depending upon the level of involvement that you have, and whether you have income or whether you have losses, you need to track that information, because again, you do not want to be audited by the IRS. They start asking you questions and you don't have the right answers for them. Let's talk about special rules for rental losses. So when we talk about accounting for S corporation, there are some special rules for rental losses, and shareholders in an S corporation must meet the stringent active participation test for real estate professionals in order to deduct rental losses in full if the S corporation is engaged in the rental property business. And S corporation rental losses are actually deductible only to the extent that the shareholder has passive activity income, if a shareholder cannot meet the active participation test for real estate professionals. And so the thing here is that things become a little tricky if you have multiple properties. It also depends on the city you're in, so the city and state you're in. And the bottom line here is that you need to actually make sure that you are compliant with the rules, the local rules, and especially if you have multiple LLCs and you have some LLCs are, let's say, some LLCs are filing as an S corporation. In other words, they're filing taxes as an S corporation, but they are LLCs. Because remember, when you have an LLC, you can file as an S corporation for tax purposes, or you can file as a C corporation for tax purposes. So if you elect S corporation taxation, then you still need to actually pay attention to the accounting part of things. Okay, and the thing here is that now S corporation, I have to specify that S corporation do not have to use accrual accounting. They don't have to, unless they have inventory. Okay, in that case, the S corporation must use the accrual method. However, the IRS does allow an exception to this rule for small businesses with inventory. So again, as I said earlier, the best strategy, the best criterion is to have an accrual method, because this is the US GAAP. This is the method that really complies with US GAAP. But you can also use the cash accounting, or you can use something like a hybrid between cash and accrual. And so the thing here is that if your S corporation has more than $250,000 in net receipts and assets in any given tax year, then you must include a balance sheet when you file your S corporation return, and this is actually called Schedule L. But even if your firm falls below the $250,000 threshold, it's still a good idea to maintain a balance sheet throughout the year and include it with your filing. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about accounting for S corporation, and actually I gave you a couple of information, a piece of information. We talk about the capital accounts. We spoke about loans, passive activity rules, investing cash in property. We spoke about the shareholders equity, and so on and so forth. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.